Is the stock market too high? Is it too low? Is it just right, Goldilocks? There's one chart, there's one analysis, there's one data point that scares me about today's stock market. I'll explain coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. All right, so if I'm looking at the overall stock market, is it easy to tell? Is it too high? Is it too low? Is it just right? And it's tricky because the stock market should be making all-time highs. It goes up and down, but it's normal for the stock market to be making all-time highs. Almost hit a record for number of all-time highs hit in 2021. Okay, very, very close. So is that normal? Is that in and of itself an indication that, oh, the stock market's way too high? No, it's not. You got to look at other data points to see if the market is where it's valued. Okay, and there's lots of different perspectives out there, and depending on where you go and what your leaning is, you could really listen to all the folks that are negative on the market or all the folks that are optimistic or positive. So you could have an ear tuned to just hear bears. You could have an ear tuned to just hear the bulls. Try to be balanced. Okay, try to be balanced. When I'm taking a look, and our CFPs at Korhorn Financial Group are looking at the markets, there's one valuation that we look at probably more than others, and that's the forward price to earnings ratio. We'll get into that in just a second. But there's a few others as well. And guys, there's one right now that scares me. There's one that scares me. So if I'm really bearish, it's because of this one chart. Let me get into that. All right, so when I'm looking at the market, seeing where it stands as far as evaluation, I always look at the forward price to earnings ratio, okay, the forward PE ratio. The favorite chart that I have to look at comes from JPMorgan Chase. You can see it here on the screen. This shows over the past 25 years that forward price to earnings ratio. A couple reasons why I like this. So the price of the stock compared to the profits of that company. Well, that's a good measure. That's how many businesses are valued, okay, so that makes sense. But I really don't care about the price today compared to the past earnings, because that's not how the price of the stock market works. It's a forward, it's a leading indicator. So projecting, comparing that price to projected earnings, that's what I care about. So if you're looking at this chart here, the past 25 years, you've got that street right in the middle. That's the average. The average is just under 17 times, 17 times forward earnings. Well, way back in 98, 99, 2000, you can see we're well above that level. Yeah, they call that the tech bubble. They don't call that the tech time period. No, the tech bubble, meaning those valuations were too high. They were too frothy, okay? And this chart shows that as well. Compare that to 2008, that time period where the actual number was well below that street, those averages in the middle. And yeah, no, that was a great financial crisis. No one wanted to buy anything. And so, yeah, the stock market was cheap, okay? Well, look where we are now. We've been bouncing around above that one standard deviation, so let's just say high, for a while now, and it's oscillating back and forth because earnings are just going crazy, and so in future expected earnings, those are good as well, and so yeah, the stock market is high, but it's even high compared to record earnings and record projected earnings. That's alarming to me, but it's not the scariest chart. By the way, if you take a look at this and then say, well, what does this mean? Okay, so the stock market is high. What does that mean for one-year returns? Well, take a look at this chart. It means nothing. It means nothing for one-year returns. On the left, that scatter plot, no, it doesn't matter. Multiples, whether the stock market is valued at a high multiple, low multiple, in the short term over the next year, it doesn't matter. It really has zero influence on or correlation on what the return is going to be. But over 5 years, now that correlation's a little bit stronger. It's not 100% correlated. It's not perfectly correlated, but it's a little bit stronger. And so you can tell here we're on that expensive side of the perspective here of the spectrum, where we shouldn't be too surprised over the next 5 years if the stock market doesn't perform as great as it has over the long term. Okay. So that's one thing we look at. Another thing that we look at, the Shiller PE ratio. This is an inflation adjusted and smooth, so averaged PE ratio. So it sort of smooths out some distortions and also accounts for inflation. So it's a real earnings in the PE ratio. And you can see here, this one is alarming, okay? Lots of people have been pointing to this chart saying, wow, everyone watch out, right? We had this extremely high PE ratio back in the tech bubble. And of course, it got really cheap during 08, and we have been straight up. This one hasn't been oscillating around those high levels. It just continues to shoot higher here. So is this the chart that scares me? It's not. I'm aware of it. I'm looking at this, but this isn't the one that scares me either. The chart that scares me about today's stock market is this one, and that is the price to sales ratio. Okay, when you're looking at a company's or your return on investment for a stock, you're going to look at how much am I paying, what's the price of that stock, compared to the revenue minus the expenses equals the profits, because that's at least some sort of connection to what you're getting, what your return is on that investment. Okay, they could pay that out in dividends, they can reinvest it to help grow the business or innovate for the future, something like that. So that price to earnings ratio, that's a good measure. But when you're comparing the price to just the revenue, not even expenses to get to profit, you're just comparing it to the revenue, that's a whole different other thing. I mean, to me, that should be a more tempered a chart. And also, there's a lot of creativity that these accountants and these CPAs for these large companies can do to make their earnings look a certain way during certain period of times. Well, there's no way to manufacture and scrub revenue, right? Revenue is what revenue is. I mean, unless you're Tesla and you're getting a bunch of revenue from the government for these contracts. But revenue is what revenue is. That's it. That's it. So price compared to sales or price to revenue, like that one should be a much clearer chart and should be pretty smooth over time. Look at this chart, guys. We are at record high price to sales. We are at 3.2 on average for the S&P 500. 3 times price to sales, price to revenue. That is unbelievable. And you can see, going back to history, nothing's anywhere close to it. Nothing's anywhere close to this current time period, how expensive the stock market is, the average stock is compared to its sales, the revenue of that company. This chart scares me. Take a look also at how many of these, how many companies, what percentage of stocks, how many stocks are trading above 10 times sales, what that means. And there's a famous quote from, I think, Sun Microsystems back in around 2000, where his stock was trading at 10 times sales. And it was just full of sarcasm, but basically saying, okay, so for these prices to make sense, our company for the next 10 years should not have any expenses, must maintain our market share, and even without reinvesting into innovating new products, needs to be able to continue to make sales at this level for the next 10 years, and then investors will be made whole. I'm butchering that quote, but dripping with sarcasm, saying there's no way these valuations make sense. The amount of companies trading above that 10 times sales is record. This is the chart. This is the chart that scares me. And gosh, if I can be so bold, we'll see how this airs. This is the chart. Whenever this bubble does pop, or whether things smooth back down at some point in the future and we have a soft landing, which would be wonderful, we'll turn back to this chart and say, yeah, we knew things were expensive. What does this mean? The reason why I wanted to show you what I'm looking at and then what concerns me is there's no perfect chart, there's no perfect equation, ratio, whatever, to look and say, okay, now we should be scared. Now's the time to watch out. Okay, there isn't. Okay, so you've got to look and have some perspective. The perspective is the stock market is high. It's expensive. There's no correlation though between that and, okay, well, tomorrow things are going to drop. The other thing that I would remind you of, investing is not about being in it when it's going up and getting out of it when it's going down. Not at all, guys. Take a look at the long-term perspective of the market. It's time in the market, not timing the market, okay? To be a successful investor, you don't need to time it perfectly so you're only in when it's going up and get out when it's going down. That's not a successful investor. A successful investor is one that has a prudent strategy that they're following, that they follow during the ups and downs of the market, okay? And that they hold for the long term, that's consistent with their overall financial plan. You're not taking more risk than you should. You're not being speculative. You're not in an investment strategy that while it's working, you're happy, but when the market goes down, you abandon it, right? That's not a successful investor. Okay? Successful investors are ones that have a proven strategy that they're using, that they can ride through that strategy during all the ups and downs, during all cycles, and that it's consistent with their overall financial plan. So work with your CFP on that. Make sure you've got the right investment strategy, that you can hold it during, the ups or the downs that inevitably will follow at some point out there in the future, that you've got a sound strategy and that is connected to your overall financial plan. If you don't have a CFP that can help you with that, you can always find one on my team. We're happy to help you. You can find us online, Korhorn.com. That's Korhorn with a K. Wise Money Show, you can find us there. WiseMoneyShow.com, you can find us there. Or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.